Cross-asset signals are flashing red and green at the same time, with AI-fueled growth, rising long-end yields, and a weakening dollar pulling portfolios in different directions. Welcome to vTalkInsight, Allocator's Lens Daily for August 24th, 2026. Let's start with equities, where strong earnings and the AI build-out are colliding with a much higher cost of capital. In equities, the core tension is between exceptionally strong earnings and a steadily more demanding rate backdrop. Nominal U.S. growth running in a 6 to 12% range, largely powered by the AI boom, is a very different starting point than the pre-pandemic era and is feeding through to corporate revenues. Recent reports point to year-on-year earnings growth of around 35% supporting valuations, and upcoming third-quarter results are flagged as the main driver of equity direction into year-end. Leadership has broadened beyond megacap AI names, with small caps, mid-cap industrials tied to reshoring, and even traditionally defensive utilities now participating as AI-related themes spread across sectors. NVIDIA sits at the center of this story, with expectations for revenue and profit to nearly double and margins to hold in the mid-70s despite higher input costs. Markets seem less focused on the headline beat and more on whether the stock can rally from already elevated levels, and what NVIDIA's guidance implies for the broader semiconductor complex and hundreds of large-cap peers leveraged to AI capex. Globally, dispersion is pronounced. Emerging markets have quietly outperformed this year, helped by AI in Asia and commodities elsewhere, yet remain under-owned after a decade of disappointment, while Japanese equities benefit from improved shareholder returns and sector stories in banks and defense. In contrast, European indices have just come through their longest losing stretch since 2016, pressured by higher energy costs and lackluster sentiment despite solid earnings in many business-to-business names. The challenge for equities is that this optimistic earnings narrative now competes with long-dated treasury yields above 5% and a cost of capital that is rising for both governments and corporates. There are growing questions around whether AI and infrastructure capex, while powerful today, can maintain current growth rates beyond 2027 without eroding returns or forcing tougher capital allocation decisions. We are already seeing pockets of strain. Citigroup's cuts to price targets from major U.S. retailers on weaker comparable sales, together with recent drawdowns in memory chip leaders and a 6-day losing streak in NVIDIA ahead of earnings, underline how quickly sentiment can swing when financing costs climb and positioning is crowded. With the S&P 500 choppy, but still up on the week and volatility in the mid-teens, the picture is one of momentum that is fragile rather than broken. For multi-asset allocators, the key equity questions now are whether earnings can keep outrunning the bond market and how quickly leadership rotates if long-end yields lurch higher again. That takes us directly to rates, with a higher-for-longer narrative is being stress-tested in real time. Rates remain the macro fulcrum. Persistent fiscal deficits, sticky inflation pressures, and enormous capital needs from the AI and reshoring build-out are all pushing term premia higher and keeping the long end anchored in a 4 to 5% plus range. Commentary now routinely describes U.S. bond market volatility as resembling emerging markets, with long end yields hitting levels last seen in 2007 and intraday swings amplified by algorithmic trading and shifting expectations around issuance. The 30-year near 5.2% and the 10-year close to 5% are drawing renewed scrutiny from both macro investors and the public. The Treasury is trying to lean against this by ramping up buybacks, signaling potential for several $1 billion in operations aimed at improving liquidity in thinly traded issues and stabilizing the long end. But skepticism is high, as markets focus on a $40 trillion debt stock, heavy reliance on short-term bills, and record long-dated issuance not just from government, but also from large technology and telecom borrowers funding AI investments. Recent softer inflation and retail sales have trimmed the perceived odds of near-term Fed hikes and even sparked a rally in parts of the curve, yet upcoming PCE inflation and the Jackson Hole speech by Chair Warsh are seen as critical catalysts. A hawkish surprise, or even continued ambiguity about the path back to 2% inflation, could easily push term premia higher again. Many institutional investors are reported to favor cash, short-term paper, and money market instruments over long-duration bonds, reflecting unease about rollover risk, fiscal uncertainty, and a positive correlation between bonds and equities. At the same time, some see 10-year yields near 5% as increasingly competitive versus equities on an income basis if growth slows. For allocators, the near-term focus is on how upcoming supply auctions clear, how PCE prints relative to expectations, and whether Jackson Hole offers a clear reaction function or adds to uncertainty. Those outcomes will heavily influence not just rates, but also valuations across equities and credit, where funding costs are quietly resetting. Credit markets still look deceptively calm on the surface. Spreads across many sectors sit near historic tights, even as nominal yields on high-quality paper in the 5 to 6% range are described as attractive relative to recent history. Beneath that calm, an AI-driven funding wave is reshaping the landscape. Investment-grade issuance linked to AI and telecom is projected in the hundreds of billions of dollars, with some large chip and infrastructure deals alone running well north of $60 billion, and using structure vehicles that shift risk off balance sheet, but still leave meaningful exposure. Private credit has stepped into the gap left by bank lending post-crisis, raising questions about leverage and transparency, while credit default swaps on leading AI tech names are starting to price in more risk as these once cash-rich companies tap markets aggressively. High yields of 7 to 8% on some AI-related debt are pulling capital away from equity at the margin. For now, strong nominal growth and earnings are supporting corporate balance sheets, but commentary flags that cash needs are rising even faster than earnings in some sectors. The main watch points in credit are the pace of AI-related issuance, evolving private credit standards, and any signs that higher funding costs start to bite into corporate strategy or employment. Those stresses would likely show up in FX and hard assets next, where the dollar and gold are already telling their own story. In foreign exchange, the dominant narrative is a softer U.S. dollar against all major peers, despite U.S. yields and growth making it an expensive funding currency. Talk of fiscal debasement, expanded Treasury buybacks, and a more dovish-leaning Fed path is fueling expectations of a renewed, longer-term downtrend. This weaker dollar backdrop is supporting global risk assets and powering a classic debasement trade in gold and Bitcoin. Gold is on track for its strongest monthly gain in decades, while Bitcoin's latest rally has been amplified by the liquidation of billions in short positions and strong gains in crypto-exposed equities like Coinbase and MicroStrategy. At the same time, high U.S. yields limit the case for very aggressive dollar shorts, and policy surprises can still deliver sharp squeezes. From an allocator perspective, FX is increasingly about funding choices and how de-dollarization narratives intersect with real rate differentials and liquidity-sensitive assets, such as crypto. Commodities round out the picture with a firmly inflationary and geopolitical tone. Gas prices have surged by 40% in Europe and even more in Asia. Storage is low, and fresh disruptions in Middle East and Ukraine are tightening diesel and refined product markets. In oil, sanctions and a coordinated push to isolate Iran, combined with the risk of new transit fees in the Strait of Hormuz, are keeping a geopolitical risk premium embedded in crude. China's earlier pullback in imports helped stabilize prices, but signs of renewed buying, especially with Iranian barrels constrained, point to support for prices into year-end. Gold sits at the crossroads of these macro and policy risks. Central banks remain steady net buyers. ETF inflows have returned, and gold is increasingly framed as a hedge not just against inflation, but also against fiscal sustainability concerns and the breakdown of traditional stock bond diversification. For portfolios, the key is how far this structurally stronger bid for commodities and precious metals can run before it feeds back into inflation data and forces another round of rate repricing. Stepping back, the cross-asset picture shows equities still riding a powerful AI and earnings wave, even as long-dated yields, fiscal anxiety, and record capital needs steadily raise the hurdle rate. Rates markets feel more like a risky asset than a hedge, with elevated volatility and term premia, while credit remains tight, but increasingly shaped by AI, funding, and private channels. The weaker dollar, together with strong flows into gold and Bitcoin, underlines how investors are reallocating away from pure duration toward real and alternative stores of value, just as energy shocks reintroduce upside risk to inflation. For allocators, the next catalysts are clear: PCE inflation, Jackson Hole messaging, treasury supply, and the coming earnings season, particularly from AI bellwethers, will determine whether the current mix of strong growth, high yields, and a soft dollar can persist. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.